We've all been there before. We have a bunch of good trades or investments and then feel really good about ourselves as we should. And all of a sudden, it just goes bad. And we start getting into a point where not only psychologically is there damage because we keep losing money, but also because we lose money financially. Of course, it's not a good deal. Let's talk about this here today. Hey, folks, this is Serge Berger, your host of the Steady Wealth podcast. And as you guessed it, today's topic is how we can manage and deal with losses in trading and investing, which is, I think, fair to say happens to everyone, and how we can bounce back from that. I've got a couple of favorite techniques that I will share with you today. Now, to be fair, also, this is a very broad and a very big topic, and it's probably one that is certainly, in my view, not done justice by just talking about it on a podcast a little bit. But really, this is there's an entire field of study here. It really goes deeply into psychology. But you may have heard of it that trading and investing, a lot of it happens between our ears. And if I think about the best traders and investors that I know, whether they're private investors or institutional investors, they seem to have a really good ability to stay neutral and open to all outcomes. So before we even look at how we can bounce back once we're in a situation where there are drawdowns, let me go through a few things that I think are prerequisites to even understanding how we get to that point. First of all, what I think is important as a mindset for trading and investing is that the returns are not linear. And when we talk to our clients, whether it's over on the Steady Trader side, where we have our research, or at Blue Marlin, our investment advisory side, too often still, even despite all our efforts, too often still we see there's a lack of wanting to comprehend the fact that returns are not linear in the market. In other words, our clients or prospects just cannot understand or want to comprehend the fact that they will not be able to make money 10 out of 12 months in that order, right? But the way to think about it, and just to even get into the right mindset to be able to ultimately fight back from losses or ultimately minimize losses, is thinking about a dice, right? And let's say you have a magical dice that 7 out of 10 times basically gives us a favorable outcome. Don't think of it like a normal dice. Let's again just think about a hypothetical dice that 7 out of 10 times is going to give you a favorable outcome. In other words, a trading or investing strategy that 7 out of 10 times trades or investments will be profitable, or at least have been in the past. Typically speaking, when I say that number, 7 out of 10, people can do the math, that's 70%. Typically, people think right away, okay, that means that when I'm going to do 7 trades, I'm going to have 7 winners in a row, and then I'll have 3 losers in a row. And of course, the more you think about that, that is, of course, never, it can happen, but it's extremely unlikely that that's the way it's going to happen. Because just thinking back to basic, math back in grade school, there's many different ways in which we can have that outcome of 7 winners and 3 losers, right? We can have a loser, then a whole bunch of winners, and then a loser here, and then a whole bunch of winners, right? It's completely random is the point. And when I think of people coming into the market and they try a new strategy, for example, or they're just new, and they start off with 3-4 losing trades, most of them are done calling it a scam, calling it crap, calling the strategy useless, sending hateful messages. That's the typical reaction. However, people that have a bit more experience or a bit more grit tend to see that, okay, given this 3 or 4 trades, it hasn't worked, but that's not really a really good sample size, is it? And that's exactly right. Oftentimes, in fact, more oftentimes than not, certainly at least with strategies that we deploy, I see people that are willing to stick through a few losers, even if they come right off the bat, 3-4 losing trades, which is, of course, not a good start. They would very quickly start to see that the averages start to work out in their favor, meaning all of a sudden you have a bunch of winners, you'll have another loser again, right? And maybe even a bunch of winners, and all of a sudden, what you thought was a catastrophic start, and it was, ended up just being just a random distribution of having the same results ultimately as 7 out of 10 winners, right? Just in a different path. And I think if traders and investors, particularly ones that are new, would just even give that a chance, that concept, they would be a lot more care, a lot more understanding, and ultimately also when they do go into a drawdown, because drawdowns are normal, it's the cost of doing business, would then be in a better position to fight back. And again, we'll get to that. Um, the other thing to understand is when it comes to the distribution, is that you can have the other thing happen. And this is where actually it's even worse for traders, where they start off with something that has, let's say, again, a strategy that has 7 out of 10 winner, right? Kind of odds. And they start off with 5 winners and they're on a high. Oh my God, this is unbelievable. Right? And we see this a lot. People use one of our indicators. They have nothing but winners for the first who knows how many trades. We get beautiful love letters. And then, of course, at some point, they will have a loser or two. And then all of a sudden, it's like, what? I thought this is all winners. No, it's always going to be a losing trade. Guess what? That's normal. That's the reality. That's life. That's trading. That's investing. That's just how things work. So understand the random walk. I think that's really important. So that's maybe point number one. A second point that I think is extremely important is to, when it comes to the linear thinking, as we just talked about in point number one, if we do get into a drawdown, let's make sure we don't start revenge trading, right? Revenge trading or revenge investing is probably one of the worst ideas. And it goes something like this. So again, I've had a good experience, things work, and then all of a sudden I have a bunch of losers, I have a drawdown. I'm in a mental state where I get to the point where I'm in revenge mode. My account is down X amount of money, and I want to get back to break even or even make money as quickly as possible. So the typical revenge trading is one of several things. Either more aggressive, meaning taking on bigger positions and less risk management, or, and it's very similarly related, we start using other instruments that have more leverage that we're not used to. I've seen as many times someone going from a stock trader to all of a sudden hearing, you know what? Oh, I could trade futures or options because they have more leverage. So if I just have one winning trade in the futures trade, I can get my money back right away, right? And of course, you know what happens? They end up not having that first winner, and because it's an option, a futures contract has got more leverage, or an options contract, and they start losing more and digging themselves deeper and deeper into the hole. So we don't want to do that. Now, before I get to what I truly think is the best one, the best tip I can give anyone for fighting back from losses, and I want to be careful about how I word that, because again, I don't want this to sound like revenge trading, because there's a gray line between revenge trading, as I just said, and just fighting back mentally and literally the account size back up in a non-revenge trading way. But let's understand that one of the easiest ways to get our head straight, because if we get into a hole, when again, it's very normal, the best hedge funds in the world have all had big drawdowns. It's what happens. And if some guy on YouTube tells you how great he is and how he has no losing trades ever, and this, that, and the other, first of all, he's not being compliant in any way, and he's totally lying. Just understand that is not real, right? In the real investing and management, investing and trading world, it's understood that there are account drawdowns. The question is, how do we handle them? So again, before I get to my number one idea, here is a couple things we need to keep in mind. Let's learn from our mistakes. So again, typically, unless the people who stay in this business, and again, those are the ones that are willing to try something and understand that there might be a random distribution of winners, right? So if a new strategy, as I said, has 3 losers in a row and they give up, I'm sorry, but that's no track record. 3 trades. Are you kidding me? That's nothing. So small positions, I think, by the way, is another big thing, and we'll come back to that in a minute. But learn from your mistake. I think there's so many reasons to quit trading and investing, and a lot of them have to do with basically irrational thoughts. Again, having a linear expectation of linear results, having expectations of just being able to open a broker account and make money. It's roughly the same thing as saying, I've never played golf, I'm just going to buy some clubs and I'm going to go on the PGA Tour, right? Crazy. Learning from mistakes. I think reviewing trades, keeping a trade blotter, or just journaling can help. I know that's not for everyone. I personally actually find that quite difficult, but I have other ways of writing things down and learning from my stuff over the years. Staying disciplined is another big one. I think staying disciplined helps us helps us get out of trading and investing ruts quicker. In other words, if we have a process, if our process changes every day, it basically means we have no process. So if, let's say, John wakes up in the morning and his process is that he wakes up, he starts looking at global markets, then he starts narrowing down. Maybe there's a few headlines, maybe there's a couple of research reports he likes to read. And then as the day progresses, he may make an adjustment to a position. Maybe he updates his profit and stop targets. Maybe he has a conference call, right? A process. Maybe he looks at macroeconomic data, very important. So there's a process. But if John wakes up one morning and depending on how he feels, he might just do a little bit of day trading with no research, or all of a sudden just look at his 401k for 3 months and not look at anything else. That's not a process. Or if he goes from a technical trader to a fundamental trader overnight and back and forth, there's no process there. So it becomes very difficult. In fact, I would argue it's impossible to build any confidence. Now, of course, if you're new to trading and investing, you need to find a process. So there's a discovery period there, of course, and that takes time. So try different things. That's really important. I try new things all the time, but within the sort of the limitations of, or the box that I have within my process. So I think that's important. Now, constantly seeking support and education is important, which is why I'm such a big proponent of using an investment advisor. And I keep, shamelessly plugging Blue Marlin Advisors here, but I see how much more grounded and keeping from making silly emotional mistakes people are when they have an investment advisor, whether it's us at Blue Marlin Advisors or another investment advisor that actually follows the markets, not someone who makes a financial plan. I think there's so much to be said about having someone to talk to about an idea, right? Even if that idea that you like to ponder is not coming from an investment advisor. Maybe it's something you read, maybe you heard at a cocktail party. Let's have someone to talk about that idea with that has experience in the markets and maybe and hopefully really knows you, your overall circumstances financially, your goals, your limitations, your risk tolerances, and so on and so forth. So that's, I think, another really big point. So staying disciplined, having a support team, all that is really important. And so that gets me to, I know this is short and sweet, but this really does get me to what I think is probably, at least has been for me, the most steady way to get back to break even, not only in the actual accounts when I have a drawdown, but also psychologically gets me back into a better spot. And this is going to be more geared towards a trading oriented book, right? If you have an investment book, and I certainly have lots of investments, like investments aside from trading books, trading accounts, an investing portfolio uh, by nature takes more time. And we see actually less investors make these mistakes of revenge investing or trading, that traders are typically where the bulk of the problems are because they have such short time horizons. Investors by nature tend to be more research driven. They have a lot more time, right? Tend to be less immediate gratification driven. And there's a lot to be said for that. So by all means, please do make sure that you take investing also very seriously as opposed to just the trading. But let's talk about the thing about trading, right? So what I find, and this can be done with investing as well. It's just that investing has shorter time and longer time frames and thus less frequency. But with trading, what I like to do when I get into a situation where either don't understand the market, things are just not going my way, I have a bunch of losers. What I tend to do, first of all, is I tend to trade smaller. So instead of risking X amount per trade, whatever that X is, that everyone's got different account sizes, so I can't give you a number for you that would constitute financial advice, which I can't give you. But whatever that number is, divided by 2, divided by 3, divided by 5, right? Again, doesn't matter what it is, but smaller. Because the smaller our risk, our capital at risk, the less emotional we are about it, right? Which also has the advantage of maybe giving us a bit more room for error. A lot of times traders specifically have not only time stops, if they have them at all, but really price stops that are really way too narrow, considering how volatile trading can be. So that's number one. Certainly, I will trade smaller. The other thing, and this is really the big thing, and it surprised me when I first heard about this 20 plus years ago, is to trade quicker. Now, let me define what that means. It may not mean what you just think. Trading quicker to me, as far as regaining my confidence, means taking profits more quickly and stop losses too. And this kind of goes in the opposite direction of what I just said before about smaller size. But if you think this through, you'll see how it's really the same. It works together. So if I have a trade in smaller size and I'm just going to say a random number. Let's say I'm up $250. Typically, I wouldn't consider taking a profit if I was up, unless I was up at least 500 or 1,000 or 2,000 or whatever, 50,000. It just depends on the account size. But by booking profits more quickly, not only does it more quickly maybe build up the account in small size, but much more importantly is what it does to me psychologically. What it does to me psychologically is say, what? I'm booking all these gains. They're not huge, but hey, I'm booking gains. I'm making money. And you start getting a feeling again of, hey, I've done this before. I can do this. And to me, that really has been time and time again a wonderful way to fight back from periods in the markets in time when I just either wasn't psychologically in the right place to make good decisions or my best decisions, or just didn't understand the market, which happens more often than not, to be honest with you. Markets are only a few times a year. Most professional trade investors really have a clear view a few times a year when things seem to make sense. And that's really when we press our bets, which is the last point I'm going to touch on here in just a second. But again, my favorite way of fighting back, and again, this is not about revenge trading. It's about just getting myself back into a position where psychologically I'm once again more confident. And the quicker I book a gain, the more frequent I do that, the more I can regain my confidence. Last point is about what I just said about putting myself into the position where the few times a year when I see the best opportunities, and I never know when they are. They could be in January, they could be in June, they could be in December for all I know. And they're random. They come at random parts in the year, right? That's another thing about the calendar year. The most successful traders and investors I know are extremely patient, right? Which is the complete opposite of the vast majority of them. They think there's something to do every single day, and they don't understand that there are times throughout the year when the odds are just so much better than others. And I don't know, I can't quantify that or even qualify. It just depends on what the setup is more broadly. But when I see that moment taking place, right? Like an easy one, for example, and this is, I'm going on a limb here because I don't want people to start saying, oh, that's all I have to do. No, but an easy one that from a market, it's not even a seasonality thing. That's an oversimplification, but it tends to happen is the sort of year-end rally. It's the fourth quarter rally, really. And this year, as I'm recording this year, we have an election year, so I would be more careful this year because other dynamics at work. But typically speaking, buying U.S. equities, the market risk assets, at some point in October and playing that theme into December, that tends to be a profitable trade. It doesn't always have to be that, right? It's making very clear. But if I see that happening and it's lining up with the way things have happened in the past, that is a high probability bet, at least for me, historically speaking. And I would be willing to bet quite a bit more in that setup than at another time of year when I'm just not understanding what's going on. So knowing when to quote unquote bet more and when to just take a step back is, I think, really the art of navigating through the markets. And I think a lot of individual investors at home would be well served to know that when I think of the best managers that I know, some of them literally, and more often than not, will shut down their operations for the summer. They will even square their books, right? At least the trading books, maybe not the investment book, but the trading book for the entire month of July or August or August, right? And then come back maybe in September. For most retail investors, traders that are constantly at it, that's unthinkable. But the best investors, at least that I know, tend to do that. So anyway, there's a few tips and tricks here for how to bounce back from trading and investing losses. Again, a lot of it is between our ears. And so I hope this has been helpful, folks. Have a great start to the week, and we'll talk to you again in the next Steady Wealth podcast. Thanks for listening.